In 1980, the typical American home cost about 3 times the typical household income. Not cheap, but reachable. One income could often qualify. 2 incomes made it comfortable. A down payment took discipline, but not decades. People saved, they bought, they stayed. Home ownership wasn't easy, but it was predictable. Then something changed. Today, in many American cities, the price of a home is 6 times the median income, sometimes 8, sometimes more. Entire generations now face a different math. Young families earning solid salaries still can't qualify. Rent keeps rising. Down payments grow faster than savings. People work longer, save harder, move farther from where they grew up, and still fall short. So the usual explanation appears: too many buyers, not enough houses, simple supply and demand. But something about that story doesn't quite fit. Because housing didn't just become scarce, it became structurally expensive. Across cities, across decades, even in places where land isn't limited. So the real question isn't just why homes cost more, it's why the system keeps pushing them higher, and why that pressure never seems to reverse. But that still doesn't explain how homeownership itself became harder. The most common explanation sounds straightforward. America simply stopped building enough homes. Zoning laws became restrictive. Neighborhoods resisted new construction. Permits slowed development. Cities grew. Jobs concentrated in urban areas. But housing supply didn't keep up. More people chasing fewer homes. Prices rise. That story has real evidence behind it. Many cities do limit density. Local politics often protects existing homeowners. Construction costs have also climbed. Labor shortages, material inflation, regulatory layers. Developers respond cautiously, so the explanation feels reasonable. Housing supply tightened, demand stayed strong, prices climbed. And once prices climbed, saving for a down payment became harder, especially as rents increased at the same time, which meant fewer first-time buyers, more renters competing for homes, reinforcing the cycle. From that perspective, the housing problem looks like a construction problem. Build more homes, prices stabilize, access improves. But there's a detail inside the data that doesn't quite match that narrative. Home prices didn't just rise when construction slowed. They accelerated during periods when housing supply was actually expanding. And in many places, prices kept rising even when population growth slowed. The shortage explains the moment, not the pattern. Because if this were only about building more houses, the cycle would occasionally correct itself. Prices would surge, builders would respond, supply would expand, and affordability would recover. But that's not what happened. Instead, something else quietly changed the role housing plays in the economy. Here's where the pattern begins to shift. For most of the 20th century, a house was primarily a place to live. Families bought homes, banks issued mortgages, communities grew around stable ownership. Housing was an asset, but it wasn't the center of the financial system. Then the structure around housing began to expand, not slowly, systemically. In the 1980s and 1990s, mortgage markets transformed. Loans that once stayed on a bank's balance sheet began moving through financial pipelines. Mortgages were bundled, packaged, sold into global capital markets. Pension funds bought them. Insurance companies bought them. Investors across the world began holding pieces of American housing debt. The mortgage stopped being just a loan. It became a financial instrument, a tradable one. This change did something subtle. It connected local housing markets to global capital flows. Money no longer needed to originate inside a city to influence its home prices. Capital from anywhere could now move into housing. And when large pools of capital look for stability, they tend to gravitate toward the same types of assets. Assets that appear durable. Assets that generate predictable returns. Housing began to look exactly like that. So demand for housing didn't just come from families anymore. It also came from financial balance sheets. This shift didn't happen overnight. But once mortgages became part of large investment portfolios, housing markets started behaving differently. Prices no longer moved only with local wages. They started responding to the availability of credit. And credit can expand far faster than income. So the question from the beginning changes shape. If home prices are tied to credit expansion rather than household earnings, what exactly determines how expensive homes become? And once that connection forms, it rarely reverses. Because housing didn't simply become scarce, it became an asset class. But that still leaves one deeper tension unresolved. If housing turned into a financial asset, why did that make home ownership harder instead of easier? At first, expanding credit made home ownership look easier. Banks could issue more mortgages. Interest rates gradually fell. Monthly payments became more manageable. A buyer who once qualified for a modest house could now qualify for a larger one. Credit widened access, but it also changed how prices formed, because home prices are not determined by the total cost of a house. They are determined by the maximum loan buyers can carry. If interest rates fall, borrowing power rises. If borrowing power rises, buyers can bid more. Prices follow the loan capacity, not the underlying cost of construction. That's the surface mechanism. But the deeper system sits underneath. Mortgage markets reward stable collateral. Investors purchasing mortgage-backed securities want predictable performance, which means they prefer rising home values. Rising prices reduce default risk. Rising prices protect lenders. Rising prices stabilize mortgage portfolios. So the system gradually aligned incentives around protecting home prices, not lowering them. Because once housing becomes deeply embedded inside financial markets, falling prices create systemic stress. Banks face losses. Mortgage bonds lose value. Households lose equity. So policies begin to lean in one direction: stabilize prices, support credit markets, reduce interest rates when housing weakens, expand liquidity when mortgages slow. Each intervention stabilizes the moment, but it also strengthens the long-term feedback loop. Lower rates increase borrowing power. Higher borrowing power raises prices. Higher prices require larger loans. Larger loans expand the financial role of housing, which increases the system's sensitivity to price declines. And when a system becomes sensitive to declines, it begins protecting increases. The housing market didn't simply grow more expensive. It became structurally protected from becoming cheaper. And that protection creates a quiet inevitability. If home prices depend on credit, and credit expansion stabilizes the financial system, then stabilizing the financial system requires protecting rising home values. That's the reinforcing loop. The system didn't set out to make home ownership harder. It set out to stabilize housing as a financial asset. But once those incentives lock together, the outcome becomes difficult to avoid. The housing market doesn't just reflect the economy anymore. The economy increasingly reflects the housing market. And that changes the meaning of the question we started with. If the system is designed to stabilize home prices, what happens to the people still trying to buy their first one? At the beginning, the question seemed simple. Why did buying a home become harder? The usual answers focused on supply, not enough construction, too many buyers, cities growing faster than housing. Those explanations describe part of the story, but they don't explain the pattern. Because the deeper shift wasn't just about houses, it was about the role housing plays inside the financial system. Once mortgages became globally traded assets, housing stopped behaving like a local good. It started behaving like financial infrastructure. Credit flows into it. Institutions depend on it. Policies stabilize it. And when a system begins depending on something, it quietly starts protecting it. Not consciously, not through a single decision, but through incentives. Lower interest rates support mortgage markets. Stronger mortgage markets support housing prices. Higher prices reinforce housing as a reliable asset. Each step makes sense in isolation, but together they form a structural gravity, one that slowly separates home prices from household income. So the original question evolves. It was never only about why homes became expensive. It was about why affordability stopped correcting itself, why the system rarely allows housing to become truly cheap again. Because once housing carries financial weight, falling prices are no longer neutral. They ripple through credit markets, through balance sheets, through retirement funds, and institutional portfolios. And when declines create instability, stability begins to depend on preventing those declines. That's the quiet design. No villain, no master plan, just incentives that align around the same direction. And inside that structure, first-time buyers occupy a difficult position. They are entering a market that the broader system quietly prefers to keep expensive, which reframes the tension from the beginning. Homeownership didn't just become harder because homes are scarce. It became harder because housing itself changed roles, from shelter to asset to infrastructure. And once something becomes financial infrastructure, the system doesn't ask whether it is affordable. It asks whether it is stable.